Most people think that the way you build real wealth in the stock market is by finding the next Amazon stock before it pops off.
Amazing Amazon. The company becomes the second one ever to hit $1 trillion valuation.
This strategy works for some people, but not most people. Actually, when most people try to invest in stocks or pick stocks, they end up losing money, either because they overpay for the stock, or they don't know how to pick a good stock, or they sell their stock for a big loss because they get scared because something's happening in the economy, or they just sit on the sidelines and do nothing. However, everybody has the ability to be a millionaire stock market investor if you know how to do it the right way, and it's not by picking stocks, it's not by trading stocks, and it's not by starting off with millions of dollars. Let me show you. If you can invest $100 a month, and this is something that everybody should be able to do. If you cannot invest an additional $100 a month, then you need to go and watch some of my other videos about how you can live smaller or earn more money. That way you can put aside $100 a month. This is less than $4 a day. But if you invest $100 a month and you can get a 10% average return on your money, which historically has been the return of the stock market over the last century, and you do this for 46 years, you will retire with over $1 million in your investment account. If you put your money in the market and you can get the market return and you do this for long enough time, you will be a millionaire. The problem is most people don't do this. Most people don't get these returns. Most people lose money and then they hate the stock market and they think that investing is only for rich people. And in this video, I'm going to go over how you can actually become a millionaire in the stock market. And it's not by picking the best stocks. But if you really want to see that success in the stock market, you have to follow a system. And this is the 3-step system that I'm going to be talking about. Number 1 is research. Number 2 is fund. Number 3 is automate. Let's start by talking about number 1. How do you actually research the right way? Now, when I talk about doing research, I'm not talking about researching individual stocks. We're talking about researching investment vehicles. And the 3 that I'm going to be talking about are ETFs, mutual funds, and index funds. And all 3 of these work very similarly with some little differences between them. But in general, the way that these funds work is instead of you going out and investing in a company like Amazon, now what you're going to do is you're going to invest in a group of companies. If you invested in the Amazon company, you put all of your money into this Amazon stock and Amazon takes over the world, this would be great news for you as an investor because now your stock price would soar. But if Amazon does something bad and the CEO runs the company into the ground and then they declare bankruptcy, well, now your investment go down to zero. So when you invest your money into the individual company, you're taking on more risk. You can see more upside, but you could also see more downside. And this is where there's a lot of work required to find the right company, to research the right company, and then you have the psychology aspect to actually how do you invest in the company. When's a good time to buy? When's a good time to sell? And this is why the majority of people lose money in the market, because they don't have the time to do the research, they don't know how to do the research, and they don't have the psychology to invest their money in the stock market. That's why for the majority of people, it's a much better idea to invest in these types of funds, because now the way it works is instead of investing directly into the Amazon company, you're going to invest into this fund which owns the Amazon company. And in addition to Amazon, it might own some McDonald's, it might own some Coca-Cola, it might own some Nike, it might own some other stocks in here. And now you have this basket of maybe 100 stocks or 500 stocks or 1,000 stocks. So now, if Amazon takes over the world, well, you're going to see some benefit here in the fund, but it'll be balanced out by some of the losers. However, if Amazon went bankrupt, then the fund would kick Amazon out and put another company in. So now you're not going to be hurt as bad by the Amazon bankruptcy because now they will replace it with another company and it'll be balanced out by some of the winners. So when you invest your money into these types of funds, you don't have to worry about doing the same type of research if you're trying to find the perfect company, because now this fund, whether it's an ETF, a mutual fund, or an index fund, is working to have the right group of companies there for you. That way now you're investing in a particular index, a particular basket of stocks, and I'll explain what that means in just a second, but you're picking this basket that you want to invest in, and then this basket will readjust based off of what companies should fit there. That way it's not a permanent group of companies. If Amazon goes bankrupt, it'll be kicked out and maybe Chipotle will come in. So these types of funds lower your risk, meaning they lower your downside, but they also lower some of your upside. However, if you're just trying to meet the returns of the market, these funds can allow you to do that without all the time and without all the risk. Now, how do you find these types of funds? Well, this is where you can look at ETFs, mutual funds, and index funds because they work similarly with a little bit of differences. So let me start by talking about mutual funds because these are what are generally known as actively managed funds. That means that the person who's managing the fund is actually a person. They're typically a well-educated money manager who you're going to be paying a fee to manage. Now, the good side here is you have somebody there trying to find you the best stocks to keep in this fund. The downfall is it's going to cost you more money. The fees are going to be higher. Sometimes the fee will be worth it. Most of the time, it will be not. Now, mutual funds work similar to index funds in that they have some restrictions. If you want to invest your money into a mutual fund, most of the time, they're going to have limits to how much money you have to invest. There will typically be a minimum. It might be $100, it could be $5,000, it could be upwards of $5 million, just depending on what the fund is. But there will generally be some minimums in order to invest. Not all of them have minimums, but some of them do. And then many times, mutual funds will also have restrictions on how often you can buy and sell this fund. Unlike a stock, you can buy Amazon and sell it within the same minute. When you buy a mutual fund, you don't have the same ability. Many times, not all the time, but many times, you can only buy the mutual fund or sell it once in a day, and there's only one slot to do that. So you can buy it only once in a day, so you can't trade out of these funds. This is kind of similar to index funds, but the difference between index funds and mutual funds is that index funds are generally passively managed. And what that means is now instead of having a money manager manage it, you are going to have a computer managing the fund. What that means is now you can build an algorithm that I'm going to invest in an index of the biggest 500 companies in the stock market. This is what the S&P 500 is. So now when you enter this algorithm, the computer will automatically make adjustments when it needs to be done. If Amazon goes bankrupt, well, then the computer will kick Amazon out and they'll put in the next biggest company. Now, the advantage of this is your fees are significantly less. Now, sometimes this will be great, other times not, but overall, what we've seen throughout history is for the average person, the higher fees tend not to be worth it. This isn't the rule 100% of the time, but generally higher fees mean it's going to eat up more of your profits. Then index funds many times also do have the same minimums like mutual funds do. This can be as low as $100 up to millions of dollars depending on what the fund is. And then index funds many times also have the same restrictions where you can't trade in and out of an index fund the way you can a stock. ETFs work very similar to index funds, but they can be actively or passively managed. So these are active or passive, but the difference between now ETFs and mutual funds and index funds is they trade just like stocks. So you have no minimums generally unless there is a brokerage that you're working with that doesn't allow you to buy a fractional share. For example, if the share of an ETF is trading for $100 a share and you don't have $100, some brokerages will let you buy a fractional share for $20. So you're buying $20 of a $100 share. But besides the restrictions to buy a fractional share, there's generally no restrictions to buy an ETF. There's no minimums, and you don't have the restrictions because now you can trade in and out of an ETF whenever you want. This is where I want to remind you that if you want to succeed as this type of investor, this is called passive investing. If you want to succeed as a passive investor, the key is you have to be a long-term investor. And by long-term investor, I don't mean 6 months. I don't even mean 6 years. A passive investor is somebody who wants to invest in these passive investments for the next number of decades. When you have that type of long-term horizon, you can win as a passive investor, but you have to be in it for the long term. Personally, I'm a big fan of ETFs because of how easy they are to access, but for other people, that's exactly why they hate ETFs, because they don't want to have to sit there and monitor the stock brokerage accounts versus an index fund or a mutual fund. If you're buying it directly from the investment institution that's issuing it, well, now it's much simpler on your end because now you don't have to stress about what's happening in the stock market and staring at your stock brokerage portfolio each and every day. It kind of happens a little bit more discreetly because you're not seeing the day-to-day price moves the way you are with an ETF. This is where now when you're picking your investment vehicle, and I'm going to go over a bunch of different examples in just a second, you have to remember what your goal is as an investor because that's going to help guide your investment decisions. And your goal can generally be, I want growth with my money, meaning I want to see the value of an investment go up, or I want cash flow, or a hybrid of these two. Growth means I'm investing my money into something that has more risk, but it has the potential to grow a whole lot more quicker. Because now these are companies that are generally smaller, they're trying to grow quicker, they don't have a lot of profits because they're reinvesting all their money back into their company, versus cash flow is now, this is a company that has big profits. They're making a lot of money, they're already very large, and now with their profits, they can just pay it out to their investors, people like you and me, in the form of dividends. So now you're getting cash flow in your hand. It's a little bit less risky, but you're going to see a little bit less upside because now these companies aren't going to be growing as fast as maybe a growth company. So a little bit less risk, but you're getting more cash flow today versus I want more risk for the potential for higher potential growth. Now, once you know what your goal is, this can then dictate how you're going to be investing your money. For me, the bulk of my stock market portfolio, especially my passive portfolio, is for cash flow because for me, I like cash flow. Cash flow funds the guac flow because when I have this type of cash flow, well, now I have investments that are paying me every single quarter, and every 3 months I get more money deposited into my investment account. Now for me right now, this money that gets deposited is being reinvested, buying more cash flow producing assets. So every week I'm putting money into my accounts. That way it can buy me more cash flow. And then when my cash flow investments pay me with cash flow, I'm using this cash flow to buy even more cash flow. So it's like a machine that's constantly working to produce more cash flow for me. Let's go over some examples so you know exactly how this works and what it looks like. Now I gotta remind you that everything that I'm about to discuss are just examples. I'm not telling you what to invest in. You have to do your own research. Investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you need to always do your own due diligence and never blindly trust a random guy on YouTube. So let's go over some examples of how this works. Let's say you just want to put your money into the stock market. Well, there's an ETF for that. There's a total stock market ETF that gives you exposure to pretty much all the major stocks on the stock market. This is VTI. So if you invested in this VTI ETF, it is by an investment fund called Vanguard. You can look it up on Google. Go to Google and search VTI Vanguard and you will learn everything about this. And what you'll see is that this gives you exposure to the broad stock market. So when you invest in this, you're getting exposure to the stock market. If you want to invest in the S&P 500, which is a group of the 500 biggest companies on the stock market, well, there's an ETF for that. And I should also tell you that these ETFs with a star next to them are funds that I have my own money invested in, just as a disclaimer. But if you want to invest in the S&P 500, then you have a couple ways to do that. You have SPY and VOO. Both of these are two different ETFs that both give you exposure to the S&P 500. They're created by different investment institutions, but they invest in the same 500 companies generally. The difference is SPY and VOO will have a slight difference in asset allocation. That means that they value some companies more than others because both of these ETFs create funds of the 500 different companies and then they allocate their money accordingly based off of what they think is the best. Well, VOO and SPY have some slight differences. Like they value Tesla a little bit differently. They value Johnson & Johnson a little bit differently. But besides that, they work primarily the same way. Now, these are two ETFs. VFIAX is the index fund version to invest in the S&P 500. So now, if you put your money into this index fund, now you're investing into the S&P 500 through an index fund as opposed to an ETF. VOO and VFIAX work very similarly. This is an ETF, this is an index fund. They're both created by the same Vanguard. If you wanted to invest in the NASDAQ, which has a lot of exposure to tech companies, then you can look into the QQQ ETF. If you wanted to invest in the Dow Jones, you have DIA. If you wanted to invest in just value companies, well, Vanguard has an ETF for that. It's called VTV. If you wanted to invest in emerging markets, these are countries and companies overseas that don't rely on the dollar, that are working to grow. This is VWO. So it's a way to diversify your money outside of the United States. And if you want to invest your money into dividend-paying ETFs, this is an ETF that invests in high dividend-paying companies, then you can look at something like SCHD. This is a dividend ETF. Now, let me remind you that this is not a comprehensive list of ETFs. There are so many different ETFs out there. There are even more ETFs than just this for dividend or emerging stocks or everything else. There are so many ETFs out there, which is why this is just a place to start, and then you can start doing more research. But this is where now you can start asking, who is the company that's issuing the ETF? Because if it's a reputable company, well, then that gives you a little bit of assurance. Then you want to look at the number of assets under management, meaning how much money does this fund actually manage? This is very easily accessible information with a quick Google search. And then you want to research what are the actual assets in this fund. Like when we talked about VTI or VOO, you can see that these invest in a particular group of stocks, and each website will show you which companies are listed in this particular ETF. As an investor now, it's important for you not just to stay up to date on what's happening with your investments, but what's happening in the broader economy, because that can influence your investments. And an easy way for you to do that is to join something like Market Briefs. It's a free newsletter that I created to help people like you, to help investors stay up to date on what's happening in the financial markets. It's super easy to read. You can read it in less than 5 minutes every morning. And every day we're breaking down what's happening in things like the general economy, the stock market, the housing market, crypto, the global economy, into a fun, witty, and easy to read email. So if you haven't joined Market Briefs yet, it's completely free. And I'll put the link to how you can join for free down in the description below. The last bit that I want to talk about when it comes to the research aspect of knowing what you're investing in is looking at the expense ratio and the yield. The expense ratio is the fee that you're going to have to pay for investing your money into a fund. Whether it's an index fund or an ETF or a mutual fund, all of them are going to have a fee, and the fee is called the expense ratio. And this is very easy to find. You can go to Yahoo Finance to find this, Seeking Alpha. You can go to the actual investment institution that's issuing the fund. You just have to look at what the expense ratio is. And what you'll see is that this expense ratio is the fee that you're going to pay every single year for investing your money into this fund. When we talk about part number 2, I'll show you the real cost of this fee, which is why you want to have ideally a lower fee if possible. And then the second thing that you want to understand is the yield. This is the dividend. This is the cash flow that you get. Now, sometimes you're going to be investing in funds for the cash flow. Other funds, you might not be investing for the cash flow, but they might be paying cash flow as well. This yield is the cash flow that you will get. So if it says it's a 1% yield, that means if you invested $100 today, you will get $1 in cash flow just for owning the investment. And this is cash flow that you're getting, not for selling the stock, but just for owning the stock. This brings us to the second step of becoming a millionaire stock market investor, which is now how do you actually fund your investment the right way? Now, in the beginning of this video, I talked about how if you want to become a millionaire stock market investor, you could just invest $100 a month, get a 10% annual return for 46 years, which would reach a $1 million investment portfolio after 46 years. However, what I want you to understand now is that there's 3 aspects which will influence how wealthy you become in the stock market. And these 3 factors are how much money you invest. Here, we talked about $100 a month. Number 2 is the return that you get. Here we talked about the 10% annual return. And number 3 is how much time you invest your money for. Now, the only factor that we cannot change is time, because you cannot go back in time and start investing 10 years ago. So we're not going to talk about that, which is why the best time to start this is today, regardless of where you are in the economy, because, well, the more time, the better. Time in the market beats timing the market. This is what Warren Buffett always says. So now we have 2 factors that we can talk about. One is how much money you invest, and second is the return. When it comes to how much money you invest, this is going to depend on really your lifestyle. It's how much money do you make, and how much money do you spend, and how much margin is there that you can put towards your investments. If you're not happy with how much money you're making, then you can start by making more money. Does this mean getting a second job? Does this mean working harder at the job that you have now? Does this mean you're working for a promotion? Does this mean you're working for a raise or a bonus? Now you're working to earn more money with the purpose of investing more money, because the more you invest, the wealthier that you will become. If it's not from a job, can you create a side hustle? Can you start a business? Is there something else that you can do? Maybe you get a certificate, you look for a new career, you look for a new job, you do something that way you can earn more money, because now you're earning more money with the purpose of having more money to invest. Then on the flip side is also, can I spend less money? Are there places where you can cut back? Can you get rid of your car? Can you live a little bit smaller? Are there things that you don't need that you can sell, that you can get rid of? That way you have more cash now to invest. So you can earn more and you can spend less, which will create a bigger margin, meaning you have extra cash. But the question is, why are you having the extra cash now? Are you just going to keep this cash in the bank, or are you going to put this money to work? If you put this money to work, now you will have more money. So the key here now, if you want to see bigger success, well, you need more money to invest. The more money you invest, the wealthier you will become, period. And we just talked about how you can do that. You can earn more, you can spend less. I'm not going to go too deep into now how do you earn more, spend less in this video, but I have other videos on my channel where I discuss that. Now let's talk about the return, because this is what can now make or break your investments. And I want to start by talking about fees, because I kind of hinted at that when I was talking about the research, because fees can eat up your return. If we come back to this example here, where you turn your $100 a month investment to $1 million, but this time now you're putting your money into an investment that gives you a 1% fee. So you're getting the same return, but then you have a 1% fee. Well, this 1% fee isn't going to eat up 1% of your investment portfolio. It isn't even going to eat up 10% of your investment portfolio. It isn't even going to eat up 20% of your investment portfolio. If you have a 1% fee, you're not going to end up with $1 million. You're going to end up with right around $750,000, because a small little 1% fee isn't just a 1% fee you pay once. It's a 1% fee you pay on every dollar that you invest, which means you have less money invested. And then every dollar that your dollar grows to each and every year. So now you're compounding your money, but you're also compounding your fees over the entire course of your investment. Now again, this doesn't mean that these fees are never worth it. There are some places where these fees will be worth it, assuming that now you can justify the fee with higher returns. But you're going to need much higher returns to justify even just a 1% fee, because that 1% fee can really eat up the value of your investment portfolio over time. And if now you can't get a 10% return, but you get a 7% annual return, well, now the years are a little bit different. If you're still investing the $100 a month, now it's going to take you 60 years to hit the $1 million. If you're investing the $300 a month, now it's going to take you 44 years to hit that $1 million mark. And if you can invest $1,000 a month, now it'll take you 28 years to hit that $1 million mark. Again, it's very accessible. The more money you invest, the more wealth you will achieve. But this is where understanding that these types of returns are achievable, and you can get better returns the more research you do. But this is where you got to pay attention to the fee and what you're investing in. But you have to be willing to do the research. You have to be willing to fund it. And then you got to do number 3, which is automate it. The way you can actually succeed as this type of passive investor is you want this to be as passive and automatic as possible, meaning every week or every 2 weeks or every month, you pick your own interval, but every so often, money is automatically going to be invested, and this does not change. It doesn't matter if the market's up or down. You do this for a number of years, if not decades. That way you can actually build wealth, because you need the time, but you have to have it be passive, and that means you want it to be automatic because you don't want it to rely on you. Now, there's a lot of brokerages out there that will automate this process for you. Personally, I use something called M1 Finance. I have been sponsored by M1 Finance in the past. They are an affiliate for Minority Mindset, meaning if you use any of my affiliate links for them, we will get compensated, but I want you to do your own due diligence because it's just what I like. I want you to find the best app for you. Now, if you want to learn more about M1 Finance, I have my affiliate link down in the description, but the reason why I like M1 Finance for this type of passive investing is because all they do is passive investing. They do it without fees, and on top of that, it's super simple to use. So for me, the way that I do it, and again, create your own strategy. For me, this is just how I do it. For me, every Wednesday, I have cash that leaves my checking account and is automatically invested into my portfolio of ETFs. The reason why I do Wednesday is not any sort of secret sauce or anything. I used to do Monday or Friday, but the problem was that was when the federal holidays would fall, and so there was a number of weeks where I just wouldn't get any money invested because there would be a federal holiday. So I decided to put it in the middle of the week. That way the federal holidays don't really affect my investing schedule because I want to keep investing as often as possible. For me, I like it every week just because it's more often. So I get a better dollar cost average because of that, but you can pick your own strategy for you. So for me, I have it set up so every Wednesday, cash leaves my checking account and it is automatically invested into my portfolio ETFs. I don't have to check it. I don't have to touch it. I don't have to do anything. It is on autopilot. So now it happens and I don't have to worry about it. For me, it's completely automatic, it's completely passive, and it's a tool that is working to now build me wealth on the side in addition to everything else that I'm doing. I have my active investment portfolio as well, where now I have my stocks in a different brokerage, where now I'm looking for companies to invest in. I'm looking for individual companies that I believe are good valued for me to invest in, but that is my active investments. It's more risky, more time intensive. My passive investments in the stock market are on autopilot, and now when I get my cash flow from my passive investments, it's automatically invested. So it's working to buy me more cash flow. So every week I'm putting more money into it. Some of these investments are paying me with cash flow. When I get this cash flow, it's buying me even more cash flow investments. So it's like a machine working to buy me assets, and then these assets are buying me more assets themselves. The key here for you is you don't want to turn this off because people get scared. Oh, the market's going down, so I should sell out of this. Or I should change my strategy because of what's happening outside. Once you pick the ETFs that you want, you're done on your end. Now you set it up and forget it. You don't have to touch it because now the ETF should be working to pick the investments, to pick the assets, and you just have to keep funding it. The only time you would change it is if something's wrong with the investment institution that your ETF is with, or if something is wrong with the ETFs that you invested in. If you feel like you shouldn't have invested in those ETFs and you want to change it because of that, that would be the reasons why you change it. You shouldn't be changing or selling out of your ETFs just because we're going through an economic slowdown. Economic slowdowns, recessions, and market crashes happen. They have happened pretty much every decade now. So you should expect them to continue to happen, and those are just opportunities if you change anything to buy more, and that's it. You shouldn't be changing a strategy besides that. So if you want to be a millionaire stock market investor, you don't have to go out and try to find the next Amazon stock. Instead, you can find the right funds to invest in. These are ETFs, mutual funds, or index funds. And of course, when you're doing this, you want to make sure you research the funds, see what they're investing in, and make sure that aligns with their investment goals and your time horizon. Now, you find the right funds that you want to invest in. The next thing you want to do is set up a system where you're funding these ETFs, and you want to also pay attention to the fees, pay attention to the yield, pay attention to the numbers, make sure that it aligns with your goals. Then you have to automate the system. The way that you win and actually become a millionaire stock market investor is by investing for the long term. You set up an automatic system that was completely passive, and it keeps happening no matter what, and you don't change your strategy just based off of what's happening in the economy. The C-level executives have a duty to increase the stock price. Who does that benefit? It doesn't benefit the workers unless you're taking a piece of your paycheck and you're buying some stock in your company, or unless your company is giving you some stock in the company. But otherwise, the changing stock price doesn't affect you. It doesn't affect these people unless you